Should we be taking risk off in the current environment? Today is Monday, August 17th. Over the weekend, we had a client text our main office line with the following question, effectively asking, should we be taking off some risk and buying some of these treasuries since they are yielding such an attractive yield? Well, here's the 10-year treasury yield. You can see it's currently about 4.63%. But first, I really want to zoom out and really want to highlight the fact that over the last 40 years, we've had a declining interest rate environment that has absolutely changed. We've been talking about this somewhat ad nauseum. We had a secular trend break. Now, I go through this in a little bit more detail in my book, Evidence-Based Investing. You can find this actually on page 58. Where I explain how fixed income works. We believe because of the secular trend change, as well as how bonds work, you put those two things together, we believe strongly that you need to manage risk differently than what you may be used to hearing. For the longest time, you're told that you should increase your allocation to bonds if you want to decrease your risk. We don't really think that's a wise decision in the current environment. Why do I say that? Well, even though the yields on the 10-year treasuries are going up, well, if you go back to what I taught in my book, the yields rising are on one end of the teeter-totter and the prices of bonds are on the other end of the teeter-totter. One goes up, the other's going to go down. That's how bonds work. And so as those yields have been going up, the prices of bonds have been going down. On the screen, I have IEF, which is the 7 to 10 year U.S. Treasury ETF. And you can see that's a fairly negative trend. Keeping in mind, this is going back to 2020. But if you put some measurements on the screen, that's a fairly nasty drop. Now, it's even worse on the longer term bonds. Has it recovered some? Well, yeah, it's no longer down almost 30. It's still almost down only about 25% since those highs from 2020. Now, if you zoom in, again, just zoom back out, look right here on the short end of the right side of the chart. That's a fairly negative trend. So if you're going to buy bonds, if we return to the question, if you're going to buy bonds and you're going to hold them for maturity, yeah, knock yourself out. But that's typically not what happens. Most clients are not holding on to these things for the full duration, and that's why we want to factor in price. Now, the other thing that we want to talk about is the question was, should we be taking risk off? Well, if you've been following our channel, you know that one of the things that we like to use is our proprietary VSI, vertical speed indicator. Again, I talk about that in my book. 13 out of 14 of those indicators were suggesting that we are in a risk-on environment. On the screen right now, I've got a risk gauge from our friends over at Motor Capital Management, and they're also now, for the first time in quite some time, all three timeframes in their research, they are suggesting that we are also in a risk-on environment. Despite what history suggests, their data is lining up and saying, hey, we might very well be in a risk-on environment. The other thing that we want to look at is the value line geometric average. We've been talking about this for quite some time. Remember, the S&P is cap-weighted. The value line geometric average is looking at a much broader swath of the U.S. stock market, but it's giving equal billing to every single stock. That's really important. But if you look, we are starting to break out on the value line geometric average, and this is called a base. We could argue this is a base. That base goes back to 2021. So these are all signs that we are in a risk-on environment. Now, today the market started to move down. So far, it's finding some stability. But again, you look underneath the surface, we want to look for the evidence, hence the name of my book, Evidence-Based Investing. This is the S&P 500, and down here at the bottom pane, I've got the percent of the S&P 500 that is trading above the 200-day moving average. We ended last week at about 72%. So 72% of the S&P 500 is trading above the 200-day average. You have to go all the way back to November 2024 to see an indication of that much breadth in the S&P 500. Now, if we look at IWV, same thing. We ended the week at about 67. You have to go all the way back to November of 2024 to find a breadth signal that is that strong. So in our opinion, the evidence suggests we are more likely to be in a risk-on environment as opposed to a risk-off environment. Hope that helps.